Chapter 17, Job Order Costing. We're going to distinguish between job order costing and process costing, record materials and labor costs in a job order costing system, calculate the predetermined overhead allocation rate and allocate overhead cost, record the completion and sales of finished goods, adjust for over-allocated and under-allocated overhead, and calculate job cost for a service company. Distinguishing between job order costing and process costing. So how do manufacturing companies use job order and process costing systems? Product costs are accumulated in cost accounting systems, and knowing the unit cost helps managers to set their selling prices that will lead to profits, compute the cost of goods sold for the income statement, and to compute the cost of inventory for the balance sheet. This is an example of unit cost. So we have different types of managers and then the type of cost that they need to know. So for instance, a manager in a fast food restaurant needs to know how much it costs to make a cheeseburger. A manager in a freight service company would be something like XPO, some type of company that delivers products. So a freight service company needs to know what it costs to transport a pound of freight per mile, because normally they charge by the pound. So whatever it costs to transport per mile. And then an automobile manufacturer needs to know, what does it cost to make this car? Construction, how much does it cost to build a house? An accounting firm, how much does it cost to prepare a tax return? Why do we need to know these costs?
To know how to make profit and stuff like that.
So that we know how to price our products or our services in order to get a return, to make a revenue, to not sell it at a loss, or even hopefully not breaking even. Hopefully we're going to make something. So a job order costing system is an accounting system that accumulates the cost by the job. A job is the production of a unique product or specialized service. It could be one unit or it could be a batch of units. So when you think of a construction company, a lot of times they track their business using a customer as a job. So if we were looking at a job order costing system and they were tracking by the job would be customer Bob, would be the job. And then you'd have another job with customer Dan. So that's what job order costing is. A job order costing system, you can have unique products and costs are accumulated per the job, by the job. In a process costing system, this is an accounting system that accumulates cost by the process. It's used when companies manufacture identical units. So, for example, a company that creates pens. We create a bunch of pens. They're all pretty much the same. So we use a process costing system. Identical units. Now we're going to record materials and labor costs in a job order costing system. So how do material and labor costs flow through the job order costing system? Companies use a job cost record to document the product cost for each job. And so here we have an example. We've got a few different jobs. We've got job 27, job 28, and job 29. And so job 27, 28, and 29. And then it's telling us here for, each of these jobs, where they are moving, how they are moving through the flow of our product cost in our job order costing system. On our balance, so it starts on our balance sheet. And on our balance sheet, remember, we have the work in process inventory account, and that's where we keep everything that we are working on. So we get job 27, and job 27 needs certain direct materials, certain labor, and certain overhead. So we have job 27. Job 27 is going into our work in process inventory, and we are any costs that we incur, and we're going to credit any cost of goods manufactured. And you see that here. So in our balance sheet, work in process inventory account, any costs that we incur are debits, any cost of goods manufactured are credits. Job 27, we have incurred the cost, we have manufactured the goods. Now we're going to move over to our finished goods inventory account, which is still on the balance sheet. So now that we've moved to our finished goods inventory, we've finished the goods, so we're going to debit our cost of goods manufactured account, which closes that out, zeroes that out. Debit that account, and we're going to credit our cost of goods sold to move this out of our finished goods inventory account and into our cost of goods sold account on the income statement. And then when the job is sold, we're going to debit our cost of goods sold account, and these costs are then transferred out of finished goods with a credit and transferred into cost of goods sold with a debit. So we transferred it out of finished goods with a credit and into cost of goods sold with a debit. And I wish I had more space on here to write. But we have our T accounts, and shouldn't have made that so high. So the left side is the debit side, right? And the right side is the credit side. So that's what we're looking at when we see these accounts down here. We're debiting our cost incurred, and we're crediting our cost of goods manufactured while they're in this work in process inventory account. So the cost incurred for each job are added to our work in process with a debit. They're explaining what we're doing in this area here.
For job 29, would they have not incurred any cost of goods, or not incurred, they wouldn't have any cost of goods manufactured and credit?
Yeah, because they're just, so all these jobs are at different stages as well. Yeah. So job 27, we took it all the way through to sold. So we started job 27 and we completed creating the goods, and we sold the goods, and so job 27 is done. When we look at job 29, we have just started it, so it's still sitting in our work in process inventory account. We haven't manufactured anything for it. So we see here 27, 29, we've got some costs that we have incurred on it, but we haven't started making anything. So that's why we don't have a credit here for our cost of goods manufactured. For job 28, this one, we have incurred cost for job 28. We started working on job 28, so we have a cost of goods manufactured. And then we finished manufacturing those goods. So that's why you see this debit here for cost of goods manufactured. So we have finished making the goods. And it says here, when the job is completed, the costs are transferred out of work in process. So we completed the job, we've taken all the costs out of work in process. We took them out with a credit and transferred it into our finished goods account with a debit. And this amount is called the cost of goods manufactured. For this one, job 29, we've only incurred costs. We haven't done anything yet. And then this little note here is saying product costs for each job are recorded on individual job cost records. So we're keeping all the costs separate per job. So job 27, all their costs are going to flow through with a tag or a note that says job 27. That way we know if management wanted to pull a report on a particular job to figure out how well it was going or not so well it was going, they could easily pull a report because we're keeping it all separate in our accounting software. So each job is kept separate, job 27, 28, 29, but they all still flow through the proper accounts. So that's why we see job 27, 28, and 29 listed here. They're all going to flow through this work in process inventory account. They're going to go through goods, cost of goods manufactured, cost of goods sold, all the way down through our income statement, but we're going to keep them separate per job. So materials. Purchasing materials. Materials are often stored to be used at a later date. So a lot of times we purchase materials and then some of them are used immediately and some of them we save for a later date. Using materials in production. When you use materials in production, there are two different types of materials. There are direct materials and indirect materials. And note that materials purchased and materials used are usually different amounts. So we may purchase $20,000 in materials in April, but then at the end of April, we may only use $10,000 worth of materials. So materials purchased and materials used are normally different. It could be a penny different. Normally, they're always going to be different because what you purchase and what you use may not be the same exact amount. So here we're going to go through purchasing materials. And so we have transaction 1, materials purchased. During 2018, Smart Touch Learning purchased raw materials of $367,000 on account. Do any of you remember what purchase on account means?
They're going to pay for it later.
Yep, they're going to pay for it later. So we've received the goods, but we are going to pay for the goods later. Good job. So we purchased these goods on account. So to record that in a journal entry, we're going to show here we've got our transaction. This is transaction 1. And we're going to debit our raw materials inventory account. The debit account is always listed first. The credited account is listed second. And if you remember, you're also going to kind of give it a little indentation to show the to differentiate between your debits and your credits. And then your debit column will be on the left and your credit column will be on the right. So we've debited our raw materials inventory account for $367,000, and we're crediting our accounts payable account for the same amount. So because we purchase raw materials on account, we're paying for them later. Therefore, we have an accounts payable, money that we owe out, a liability. So here we are purchasing materials. We have raw materials subsidiary ledger. This is an example of what that looks like. We've got the item number, the description. So we have STL batteries. And then here in our ledger, we're recording, we received batteries. We received 200 units of batteries on December 5th. The cost per unit was $55, and the total cost for all 200 units was $11,000. How did we get the $11,000? So you take 200 times 55 equals the 11,000. Good job. And so that's what happened on December 5th. We received this. So then we're going to go all the way over here to where our balance is, and we don't have any prior balance. So for our balance, we're going to have 200 units at $55 per unit, and the total cost is $11,000. And then on December 10th, we issued some units. So we issued 50 units. And we're going to put in here our materials requisition number. And this is just so that we can track where this is going. So when someone requested this material, when they requested it, they had a requisition number. And in this example, the requisition number is 334. So we're going to put that on this ledger. The number of units that we gave them was 50 units. The unit cost, $55. The total cost, that was our units, times the unit cost equals the $27.50. And then we have a new balance. So our new balance, we have to take out the 50 units because in our inventory account, for our raw materials, we had 200 units, but then we issued 50 of them. So now we have 150 units. Record them at the same unit cost.
So will they not sell them for more?
So this is our raw materials. So for our raw materials, we're going to use whatever the cost was that we paid for them. This is like what we paid for, like our batteries. This is our batteries for our tablets. So we paid $55 for each battery, and now we've issued 50 batteries for 50 tablets. So we're going to issue those at the amount of money that it costed us to buy the tablets, because we're issuing them to another department in our facility. So more than likely we're giving them batteries to put in the tablets to themselves, so it'll probably roll into our cost of goods sold. So we're going to record it at the cost paid for. And now we have this new balance here of 150 units, same cost, and our total cost that we have in that account now has gone down because we only have 150 units. And then on January 14th, we had another material requisition for 15 units. We issued those. Total cost decreased because the total cost is, again, the number of units times the cost of the unit. So 15 times 55 equals 825. That is going to reduce our balance in the account. So now we only have 135 units. They're still at $55 cost. And then the total cost has gone down to $7,425 in that unit. So a material requisition is a request to transfer materials to the production floor. So we are requesting to get materials to take to the production floor to produce the tablets. So our job cost record, we have our direct materials recorded. So now we're looking at the individual job. We've got job number 27. The customer, this is for Central College Bookstore, and they are asking for 15 tablets that have accounting e-learning software. They requested this on January the 14th with requisition number 342, and the amount is $825. So here we have, so this is our second transaction. We've used materials. So in 2018, Smart Touch Learning used direct materials costing $355,000 and indirect materials costing $17,000. The $17,000 of indirect materials are transferred from raw materials inventory to work in process through the manufacturing overhead account. So we have here, we have debited our work in process inventory, the direct materials for $355,000. We've also debited our manufacturing overhead, which are the indirect materials, for $17,000. And then we've credited our raw materials inventory account for the total of the two. Most companies use electronic labor time to track labor cost. So you have certain systems like Paycom and others. There are certain systems where you can sign in using your app on your phone, or when you get to a specific location, there's an app that will actually log you for. So as soon as your phone gets to a specific location, like your place of work, it'll automatically clock you in. And when you get a certain distance away, it'll automatically clock you out. But then there are also some manual systems that are used as well. And some manual systems are, I don't know if you've ever used a system where you have, like, you get a time card and you go and you punch your time card. But you can do the time card punches. Some companies they have printout kind of similar to this, but they'll have like a printed out sheet that says, you put your name, today's date, you would put, the time that you clocked in, the time that you clocked out for lunch, you clocked back in for lunch, you clocked back out for the day. If it's a company that is tracking job costing, then you'll see a few lines and it'll say, so you clocked in for the day and then you started working on job 27. You finished working on job 27, you started working on job 28, you stopped working on job 28. So that, because those companies are also tracking your wages per job. So there's a lot of different ways that you can track your time. Of course, the more manual the system is, especially with like all the different jobs and stuff like that, it can be more time consuming for payroll processing and stuff like that. And there's also a higher margin for error because, people may write the wrong thing. People may read the numbers incorrectly. If a manual system is used, each employee completes a labor time record to track and assign direct labor to jobs. And so here they have, an area for their direct materials, their direct labor, manufacturing overhead, and they've listed that this is for job 27. Labor cost incurred. During 2018, Smart Touch Learning incurred total labor cost of $197,000, of which $169,000 was direct labor and 28,000 was indirect labor. So we're going to debit our work in process inventory account for direct labor. We're going to debit that account the 169,000. We're going to debit our manufacturing overhead account for 28,000 and credit our wages payable account for 197,000. So we're going to calculate the predetermined overhead allocation rate and allocate overhead cost. So how do overhead costs flow through the job order costing system? We're going to be looking at transactions 4 to 7, actual overhead costs incurred. So in addition to indirect materials and indirect labor, other overhead costs are incurred as well. So you may have depreciation, plant utilities, plant insurance, property taxes. So here we've incurred depreciation on manufacturing plant and equipment. The depreciation was 20,000. We have plant utilities of 7,000, plant insurance of 6,000, and plant property taxes incurred, but we have not paid these taxes yet, and that is $5,000. How do overhead costs flow through the job order costing system? So we're going to see how we would record these costs in our journal entries. So we've got manufacturing overhead. We're going to debit that account for $20,000, and we would credit our accumulated depreciation for the same amount. Manufacturing overhead, that $7,000, we're going to debit the $7,000 to our manufacturing overhead account, and we would credit cash. For the prepaid insurance, again, we're debiting our manufacturing overhead account, and we're going to credit our prepaid insurance account for the $6,000. And then the property taxes that we owe, we have not yet paid. We're going to debit the manufacturing overhead account, and we're going to credit our property taxes payable for the $5,000. Before the period, calculating the predetermined overhead allocation rate. So we have actual manufacturing overhead costs. They're not known until the end of the period, which is most cost. So when you think about like your power bill or your water bill, normally those are not fixed. Normally you're charged based on what you used. Your phone bill, depending on who your provider is for your phone bill may change every month based on how much you use it. So, or your internet bill, your Wi-Fi. So actual manufacturing overhead costs are not known until the end of the period. But we still have to kind of try to like figure out what those costs are going to be. So managers use a predetermined overhead allocation rate to allocate the cost to the jobs before the end of the period. Kind of like budgeting in a sense. An allocation base links the overhead cost to the jobs. The primary cost driver causes an increase or a decrease in the cost. We're going to see this. Common manufacturing company cost drivers, this is something to know. Common manufacturing company cost drivers are your direct labor hours, direct labor costs, and machine hours. These are all cost drivers. For your direct labor hours, you have, these are used for labor-intensive environments, labor-intensive production environments. Direct labor costs are used for labor-intensive production environments, and machine hours are used for machine-intensive production environments. And this is showing you that sheet again, just with more information. So we've requested more items. And then we're showing here, we also have a cost summary now. So the direct materials, the direct labor, and the manufacturing overhead gave us a total cost of $4,500, and our unit cost is $300. So the total direct labor cost for 2018 was $169,000. We're going to use an overhead allocation rate of 40%. So we're going to use this overhead allocation rate of 40% of 169,000, and that's going to give us our manufacturing overhead of 67,600. And they gave us that 40% right here for our rate. Overhead costs are allocated based on a predetermined overhead allocation rate. Our manufacturing overhead is a temporary account. So do you remember hearing about temporary accounts in any of your other classes? You have permanent accounts and temporary accounts. Do you remember what a permanent account is or a temporary account is? The difference? So a permanent account is an account that we pretty much have every quarter, every year. It doesn't go away. Our temporary accounts, on the other hand, our temporary accounts are accounts that we have throughout this period, normally a year, and then we have to zero the balance out of it at the end of the year. So it kind of like goes away. We're probably going to have the same account, you know, let's say our year end is December 31st. So the temporary account needs to have a zero balance at December 31st. But then we're probably going to have that same account again on January 1. But it's going to start with a zero balance. So the temporary accounts, they must have a zero balance at the end of the period. And then, so we see here, they're telling us a debit signifies the actual overhead was greater than the allocated overhead. So if there's a debit to our manufacturing overhead account, there's a debit, the actual overhead was greater than the allocated overhead. And if there's a credit, the actual overhead was less than the allocated overhead. So now we're going to record the completion of sales and finished goods. Sales of finished goods. So what happens when products are completed and sold? After accumulating, assigning, and allocating the cost of direct materials, direct labor, and overhead to jobs, a company will account for the completion of the job, they account for the sale of the job, and they adjust their manufacturing overhead at the end of the period. So in this transaction, we have completed some jobs. So we have $644,600 cost of goods manufactured is the cost of all of our jobs. So we're going to debit our finished goods inventory account. We've completed those jobs, and we're going to credit our work in process inventory account because we've completed those jobs. And then now we have sold. So we have sales on account for $1,200,000. So we are going to record those sales by debiting our accounts receivable for $1,200,000, and we're going to credit our sales revenue for $1,200,000. Now we're going to record the cost for those jobs that we sold. So we sold those jobs and now we have to record the cost. The cost was $584,600. So we're going to debit our cost of goods sold account for the $584,000, and we're going to credit our finished goods inventory account for the same amount. All right, so now we're going to adjust for over allocated and under allocated overhead. So we've either over allocated or under allocated. So now we have to fix that. We are at the end of the period and we know what the actual is. So now we just have to true everything up. So companies must adjust the manufacturing overhead account for any over or under allocation of overhead. So if there is under allocated overhead, that occurs when actual manufacturing overhead costs are more than the allocated manufacturing cost. So for under allocated, this occurs when actual manufacturing overhead costs are more than allocated. That wasn't very good. An A and an A. That was not very good. Okay. Actual is more than allocated. For over allocated, these costs occur when the actual are less than allocated. So now on this next transaction, we are adjusting our manufacturing overhead. We have a credit to manufacturing overhead of $15,400, which is needed to bring the account balance to zero. So to record this, we're going to debit our cost of goods sold for $15,400, and we're going to credit our manufacturing overhead account for the same amount. This is showing accounting for manufacturing overhead, how we account for the manufacturing overhead. So before the period, we are predetermining what we think our overhead is going to be. So we're calculating the predetermined overhead allocation rate based on what we think it's going to be, based on prior information. So we have to determine what our predetermined overhead allocation rate will be. And to figure out our predetermined overhead allocation rate, we're going to take our total estimated overhead cost divided by our total estimated quantity of the overhead allocation base. And that's going to tell us what our predetermined overhead allocation rate is. And then once we have, so now we're in the period. During the period, we are going to allocate that overhead. So to allocate the overhead, we're going to take that predetermined overhead allocation rate that we calculated before the period, and we're going to multiply that by the actual quantity of the allocation base used by each job, and that is going to give us our allocated manufacturing overhead cost. And at the end of the period, that's when we get the actual overhead. So at the end of the period, that's when we're going to adjust for any over-allocated or under-allocated overhead. So during the period, we allocated overhead, and we thought that during the period, we thought we were going to have, 20,000, I'll just say $20, less zeros to write. So during the period, we allocated $20. At the end of the period, we realized it was only 15. So what did we do? Did we over allocate or did we under allocate? So during the period, we allocated 20 overhead. And then at the end of the period, it actually was 15 overhead. So, when we're talking about overhead, so we over allocated by 5. So during the period, we allocated 20, but at the end of the period, it was only 15. So we over allocated. So now we have to adjust to fix that. And so here, this just tells us, if actual costs were greater than allocated cost, or if actual costs were less than allocated cost, and then it's telling us if manufacturing overhead was under allocated, the cost of goods sold would have then been under costed, and if that occurred, the journal entry you need to create to fix that would be, in this first example, would be a debit to cost of goods sold and a credit to manufacturing overhead. And you would use the opposite journal entry if it was over allocated. So this is just a good little go-to page. It's got a lot of information on here, and this is on slide 35. So here's a summary of our journal entries. So we're going to debit our raw materials inventory for $367,000. We credited our accounts payable for the same amount, and we made a note that we had purchased materials and accumulated that in our raw materials account, RM. Then our next transaction, we debited our work in process inventory account, debited our manufacturing overhead account, and we credit our raw materials inventory account for the total of that amount. And our note is we had some materials that were used, direct materials that were assigned to our work in process account, and we had indirect materials that were accumulated in our manufacturing overhead account. And the reason that we make these notes is so if someone else came in and looked at our records, if all this said was work in process, manufacturing overhead, and raw materials, then they don't really know what we're recording here, or what specifically we were doing. So making these notes helps out with, if you were ever audited, or if someone else, say you're doing it all now, it's your company, and then you decide to hire someone to help you because you're doing too good and you can't do it by yourself anymore. If someone else comes in, the better your notes are, the less questions they're going to have for you, which means the less time you have to spend answering those questions. So just trying to make sure that you have good records. And also, sometimes you may not remember what you did 3 months ago or 6 months ago or last year. So the better notes you have here can also help jog your memory as well. This third transaction, we debited our work in process inventory account, debited our manufacturing overhead account, and credited our wages payable account for $197,000. And then again, we have this wonderful note here that's just telling you why we made those debits and those credits to those particular accounts. And these all correspond with the transactions that we just went through on the prior slides, transaction 1, 2, and 3. I'm going to let you kind of read through these. You can also reference these when you're doing your practice problems to kind of help you if you have any, questions on the journal entries or anything like that. And again, I'll let you guys look through that. And so now here we are, we've got the account for our raw materials inventory. They had a beginning balance of $70,000. Transaction 1 debited raw materials inventory for $367,000. And transaction 2 credited that account for $372,000. So we're left with an ending balance of $65,000 in that account. An ending debit balance of $65,000 in that account. And that's how you'll read through all of these. So for the next one, for the work in process inventory account, we started with $80,000. We debited $355,000 in transaction 2. Transaction 3 debited $169,000. Transaction 8 debited $67,600. Transaction 9 credited $644,600, and that left us with an ending balance of $27,000. Here we're looking at our schedule of cost of goods manufactured. So you've got our cost of goods manufactured, and this is showing beginning work in process inventory. We are determining what our direct materials used was. So this walks you through how to calculate that, similar to what we did in the last chapter with our cost of goods sold. And then you'll come to the total amount of direct materials that you used, your direct labor. That's going to give you your manufacturing overhead that has been allocated. And then your total manufacturing costs that were incurred during the year was $591,600. Total manufacturing cost to account for, your ending work in process inventory, and then your cost of goods manufactured. And here we have an example of the income statement. So for the income statement, we have, again, we've got our sales revenue. And then if you notice here, we've got some new accounts. So we've got our sales returns and allowances. And our sales discounts, we're going to subtract those out of our revenue to give us our net sales revenue. And that's because, again, we record our revenue at the actual sales price of the product, but then we, offered it at half off, 50% off or something like that. So we have to subtract out those discounts from our actual sales revenue. Begin our finished goods. So we've got all of our finished goods and our cost of goods sold accounts here, bringing us to our gross profit. Then we're going to subtract out all of our selling and administrative expenses, giving us our operating income. Subtract out any other income, our interest expense, income tax expenses, and that's going to bring us down to our net income. Calculating job cost for a service company. So how do service companies use a job order costing system? Service companies do not have inventory or manufacturing cost. They are traced directly, they trace their direct labor to jobs. They allocate overhead costs to jobs, and they use costing information to make pricing decisions. When they're allocating overhead costs to jobs, they compute the predetermined overhead allocation rate, and they allocate their indirect costs to jobs using the predetermined overhead allocation rate. And does anyone have any questions so far?
No.
Okay. All right, so we have some practice problems that we can work